Welcome to this podcast covering the latest earnings releases from several major companies in the U.S. stock market. Before we begin, it is important to clarify that the information presented here reflects opinions and analysis for educational purposes only and does not constitute investment advice. Every investor should conduct their own research and make decisions based on their personal financial situation, risk tolerance, and future expectations. Trade Desk recently reported its latest earnings, and the numbers themselves were strong. Revenue increased by 14%, and net profits rose significantly by 73%. However, the stock still declined despite these solid results. The main reason was guidance for future growth. The company indicated that revenue growth may slow to around 10%. While this is still positive growth, it represents a slowdown compared to previous higher growth rates. The company's current P/E ratio is approximately 27, which can be considered fair value relative to the expected growth of around 10%. There are also concerns about the company's future risk profile. Trade Desk relies heavily on two large clients, and it also depends significantly on connected TV, which represents more than 40% of its revenue. If connected TV demand declines, it could directly impact the company's main source of revenue. Despite these concerns, the company continues to show revenue growth, profit growth, and positive expectations for 2026. There are no negative numbers in the current report. The stock decline appears to be driven primarily by fears about future growth slowing and business concentration risks rather than current performance. The company may enter a period of consolidation or sideways movement. There is also a possibility of what is known as a value trap, where a company performs well fundamentally, but the stock price does not appreciate for a long period. Snowflake also released its results, reporting revenue growth of 30% and earnings per share growth of 6.7%. Despite these positive numbers, the stock declined by more than 5%. Snowflake operates in the cloud sector, which is closely connected to artificial intelligence infrastructure. Cloud services are essential for AI workloads, which gives Snowflake structural advantages as AI adoption continues to grow. However, even strong companies in the software and cloud sector have experienced stock declines recently, indicating broader investor caution towards software stocks despite solid financial performance. Salesforce reported revenue growth of 12% and net profit growth of 25%. However, the stock fell by approximately 5%. The company provided guidance indicating expected growth of around 8%, which represents slower growth compared to current performance. Even though the guidance was still positive, the market reacted negatively. This reaction reflects a broader trend where investors are currently less enthusiastic about software companies, even when they deliver strong financial results and remain profitable. Nvidia reported extremely strong financial performance. Revenue increased by 73% and earnings per share increased by 82%. Following the earnings release, the stock initially rose by about 4%, but later fell back to approximately 0.22%. Nvidia currently has a P/E ratio of 39, and it is expected to decrease to 24 based on forward earnings estimates, which represents a significant improvement in valuation relative to expected future earnings. The company's outlook remains very strong. Expectations for 2026 are still high, and the CEO stated during the conference call that demand remains unusually strong. In fact, the company raised its expectations for 2026 compared to previous forecasts. Despite this, some analysts believe that Nvidia may currently be at or near peak hardware growth. They expect growth rates to slow gradually over time, potentially declining from current very high growth rates, such as 73% revenue growth and 82% earnings growth, to lower levels, such as 40%, then 30%, then 10%, and eventually single-digit growth. This expectation of slowing growth is the main reason for the stock's volatility, despite excellent financial performance. Overall, these companies reported strong financial results, with significant revenue growth and profit growth across multiple sectors, including AI hardware, cloud computing, software, and digital advertising. However, stock price reactions have been mixed or negative in several cases due to forward guidance, valuation concerns, growth expectations, and broader investor sentiment towards certain sectors, especially software. From a fundamental perspective, Nvidia continues to demonstrate exceptional growth and strong demand driven by AI infrastructure. Snowflake continues to benefit from long-term cloud and AI trends despite near-term stock weakness. Salesforce remains profitable with solid revenue and earnings growth, although slower guidance has impacted investor sentiment. Nvidia continues to grow revenue and profits, although slower growth expectations and business concentration risks have created uncertainty around the stock's future performance. These earnings reports illustrate an important market dynamic. Strong financial results do not always lead to immediate stock price increases. Market expectations, forward guidance, valuation levels, and investor sentiment all play critical roles in determining stock price movements. Thank you for listening. Make sure to subscribe to the channel to stay updated with the latest analysis and developments in the U.S. stock market.